Today, I'm going to focus on thematic investing at Chevy Chase Trust. I'm going to talk about three things. First, I'll talk about what thematic investing is. Second, I'll talk about what it isn't. And finally, I'll discuss two of our current themes and explain how they inform our investment thinking. Thematic investing seeks to find investable ideas that stem from economic or technological changes that are powerful enough to influence corporate performance across multiple industries. Basically, thematic investing examines how the world is changing, tries to determine which companies will be advantaged, which will be disadvantaged, and then buys the winners and avoids the losers. So what is not thematic investing? The antithesis of thematic investing is style box investing. This is how the asset management industry has evolved. It has steadily moved towards a proliferation of style classifications and a host of rather narrow investment products to fill these categories. Institutional investors, and even many individual investors, are increasingly using multiple managers, each focused on a specific investment style. As a result, investors are winding up with a smorgasbord of large cap, small cap, mid cap, growth, value, emerging markets, etc., and other styles that together really look like the overall markets they were sliced from. So how does Chevy Chase Trust practice thematic investing? In order for a theme to be included in our portfolios, it must satisfy three criteria. First, it must have an alpha opportunity. Essentially, alpha is a company's potential to earn a return premium over its peers in the market. A theme that has long-term potential to positively influence stock performance provides an alpha opportunity. The second criteria for a theme to be incorporated in our portfolios is maturity. We look for themes with a duration such that valuations can be sustained for at least 3 to 5 years. To give you an idea of how fast the world is changing, the first iPad ever, was introduced in 2010. By 2013, more than a third of Americans owned a tablet. Tablet adoption is now slowing due to saturation, but this was the fastest uptake of a technology in history. The time horizon for adoption of many new innovations is compressing, making it hard to identify entry points and even harder to identify exit points before investment multiples compress. But the final criteria is investability. There must be a significant number of public market investments benefiting from the theme so we can invest at least 5% of the portfolio in it. If a theme does not provide enough liquid investments with sufficient barriers to entry, it is simply a trend and not an investment theme. Finding the confluence of these three factors isn't easy. Thematic investing requires understanding the economic landscape, envisioning change, and performing rigorous individual company analyses. Done well, thematic portfolios are naturally diversified across sectors, styles, geographies, and market capitalizations. As a unifying concept, we believe thematic investing has higher return potential than an aggregation of separate managers and multiple styles without additional risk.